Netflix reported fourth quarter results tonight, and overall things look pretty strong. Shares are up about 7% in after hours. If you take a look at the U.S. streaming business, they beat on the revenue line by about $5 million. They also beat on the contribution margin line for the U.S. business. Total paid U.S. memberships came in line with their expectations. International streaming side, revenue was in line with expectations. They beat on the contribution margin. They were expecting about a 20.7% contribution margin or contribution loss, and they came in at 19.2% loss. And they missed on the paid members for international streaming business. So we're going to take a look at the new guidance that management gave us tonight in the shareholders letter, and we're going to input that detail into our Netflix earnings model and see if that price move of 7% makes sense in after hours. If you'd like to follow along, you can download this model. If you go to our website, gutenbergresearch.com, click on the free models tab, and then you can scroll down to the Netflix model and just click this button to download. So in this version of our earnings model on the right hand side of your screen, you can see that we've already updated the values for the December quarter. So we've already updated the balance sheet, cash flow statement, and income statement and segment details. And then we've also updated the segment section and the income statement for management's guidance that they gave tonight. So we can start with the domestic streaming business. So now they're expecting 45.4 million domestic paid subscribers for the first quarter. And that was about in line with the growth rates that we had estimated prior to the call. The domestic revenue, they're expecting $1.16 billion overall, which equates to $26.1 per quarter per member. And you can take a look at what they had reported the last couple of quarters, and this is now the first time that they're expected to break $26. So that's a good sign. It's going in the right direction. Contribution margin is also expected to expand from the fourth quarter, which is also another strong sign. So overall, U.S. business looks pretty good. Now for the international streaming business, they're expecting quarter-over-quarter growth of about 15.9%, so very strong, healthy growth. Revenue is about $22, just over $22 per subscriber per quarter, based on the total revenue estimate that management gave us tonight. So that's about in line with the fourth quarter, and that makes sense because it takes time for all these new markets that they're introducing. It takes time for the revenue to kick in. And one of the key items to watch here is the contribution margin for the international streaming business, because we know that the marketing costs are pretty great to launch an additional country. And so this is definitely showing good progress because they're expecting it to be well below what it was in the fourth quarter here. So we want to keep an eye on that one. Now for both the international and U.S. business going forward, we left our growth rates constant with what we had yesterday. So you'll remember that yesterday our model was calibrated to meet consensus estimates. So this view here is showing just with the updated details from the fourth quarter and the guidance that management gave us for the first quarter, what the impact would be on earnings and valuation. So we want to leave those growth rates constant for the time being. If you'd like to download this model and plug in some of your own growth rate assumptions, you can do that and see what the impact would be. And for the DVD business, management doesn't give us guidance, so we left it as is. So the last three things that management gives us guidance for are the operating income, the net income, and the earnings per share. So the majority of the operating income has already been determined based on our contribution margin for the U.S. and international streaming business. But if you scroll back up, you can see that the two items that are excluded from that calculation are technology and development costs and general and administrative costs. So since we have already input everything for domestic and international streaming, we can scroll down to our ratio section, and you can see this is where we set our ratio of technology and development expense to revenue and G&A to total revenue. So in order to get back to that $50 million that management gave us tonight, we had to set our technology and development expense to revenue to 9.9% and then G&A to 6.5%. So if you look back at the last couple of quarters, you can see that this is, stayed pretty high, and I think a big portion of this is due to the fact that they're expanding so quickly into other markets. So eventually we'd like to see that come down. That 50 million was a little bit lower than what we anticipated. But overall, still a great quarter. It's just the expenses are staying pretty high. After we have the operating income, there's just a couple of items. So we have interest expense, which has stayed pretty consistent quarter over quarter, and we left our ratio of interest expense to average debt balance consistent for the first quarter. And then other income and tax are the two sort of question marks, but you can basically get back to the net income that they give us of 11 million by coming up with a combination of those two variables. And then from there, the diluted EPS calculates based on the diluted share count, so that's in line with what management gave us tonight at 3 cents. So after we plug all that new guidance into our model, you can see that the estimated share valuation went to 103.75, so not quite the 115 that we're seeing in after hours at this point. But keep in mind that we did keep our growth rates constant, and since this was a relatively strong quarter, you might see some slight increases in growth rates from analysts after they update their models tonight. And in addition, on the price earnings-based valuation side, we were actually trading at a PE ratio that was a little bit below what we've seen in the past, the historic average. So we might be getting a little bit of multiple expansion here now after another strong quarter. So overall, the valuation in after hours, it does make sense. Be sure to join us for the Starbucks call tomorrow, or actually on Thursday. And if you're interested in financial modeling, please subscribe to our channel. Thanks for watching.